guys, welcome back to the Capital Mindset Show. Today we're going to be doing just a quick analysis on a subscriber request, and this one is on AFRM. So I'm, going to be on a break here, having a little bit of a snack, drinking some water and stuff, and we'll just take a look at a stock together. So this one was requested, and now it's here. We'll actually take a look at the price action before we begin anything. So let's actually see AFRM stock, and I'll pull that up for you guys right here, and we can kind of talk about it. So a little bit about this business for those of you who don't know what it is or have never heard of it. It's similar to Afterpay. Afterpay has been acquired, I think, by Block, used to be known as Square, and so that's already a concern right there. Boom, we have a competitor with a lot of capital, decent size, and already does other forms of business that can perhaps better integrate those services. Now, AFRM, you can use it on, I think, Amazon. So the point is, or like how this company kind of makes money is, it's pretty simple. So let's say you're selling a shirt, and the shirt is $500 for whatever reason. It's $500, right? It makes me feel really good, and I want to buy your shirt for $500. So I don't want to pay $500 up front, right? So I go through their platform, right? Not through their platform per se, but they have it integrated on your website, let's say, and then I pay over time, right? So what ends up happening is AFRM gives you, the merchant, a lower amount, and then I owe AFRM the full amount. So let's say, hypothetically speaking, you will get, instead of $500, you'll get $400, right? I'm being a little extreme there, but let's just keep it for the example's sake. You'll get $400. That $100 difference will be the risk premium that AFRM gets for taking on this loan, because essentially that's what it is. It's a loan. So I owe AFRM $500. They gave you $400. They make the difference of $100. And that's how AFRM kind of says that, oh, they don't charge an interest if you pay, they still make money, right? They still are taking on a risk. And I think it's like 6 months off the top of my head, if you do like a 6 month or 3 month, something like that, where you don't pay any interest. Now, I think AFRM is an interesting prospect in terms of what it does for consumers. Stuff like this has been around for a long time, but usually a merchant would prefer to pass on the risk. This is where I want to actually highlight this to you guys. A merchant would love to pass on the risk to a third party, right? I would rather get less money now, but get guaranteed payment and get more customers that way. That's the value proposition. I get more customers than I otherwise would have. And I don't get the risk of not getting paid, right? Because that's why, for example, you've seen probably some stores offer, oh, you do this 0%, no finance, like financing, right? 0% financing, right? So that's an effort by merchants to grow their customer base, to get more sales than they otherwise would have. So AFRM is that third party that says, hey, I'll take on the risk. I'll accept that risk, and I'll consolidate, and I'll just focus on that business type, going here and go to different merchants, right? So they want to focus on that, right? And so AFRM touts themselves as having superior technology in the sense that they're able to tell if a client is more likely or less likely to pay. Okay, because you still have to get approved by AFRM. They don't just say, oh, everyone, okay, you will get a TV, you get a TV. No, it's not like that. And I mean, I think I explored their app a little bit. You can actually buy things directly through their app, and it's like the same process. It's linked to third-party merchants, and you're doing it through AFRM. But when you go to these merchants directly, you'll still see AFRM there, and I think you guys will probably be familiar with that. Or you'll see Afterpay, but basically they're the same thing. So I want you guys to think of this as kind of like a bank. It's kind of a bank, right? Kind of like a credit card company, but not really. So I hope I made a good effort in explaining how they make money. Now, if we get to, for example, a credit card, let's look at a credit card, because a credit card is actually quite similar, right? When you swipe a credit card, you are borrowing from your bank. Your bank is paying the merchant. The merchant is paying a fee to the bank, typically, closer to 5%, something like that. And they get the money then, but I get the product. And then who do I owe the money to? Well, I owe it to the bank, right? I owe it at the credit card statement at the end of the month. It's very similar, but the credit card statement, you don't want to, you want to pay that back. AFRM basically extends the time frame, but because they do that, right, they also take a higher risk premium, right? Because they're taking on higher risk. Because a bank, it's implicit in the interest rate that if you don't pay it at the end of the month, you will pay interest, because that drastically increases the risk. So knowing that banks do that, right, specifically because that increases the risk. That inherently means that a firm's assets, right, they're going to be a bit riskier. And actually, I'll showcase that because they do admit that, right? There's three types of assets in this world, right? For the most part, for accounting classification, we have either, depending on how you call them or where you work or where you study, they'll call them differently. But class 1, class 2, and class 3, right? Class 1 is very easy to evaluate. We have class 1 being, you know, cash equivalents, stuff like that. Class 2 is a little bit more difficult, but still not that bad. And, you know, you can think of like bonds as this, so you could sell it right tomorrow, but the value is not understood, right? Because remember, currency is a unit of measure, right? So a dollar is a unit of measure, that we measure things in dollars as to how they're valued. If you're in the United States. And class 3 is the ambiguity, right? The ambiguity factor. And actually a lot of a firm's assets are actually in class 3, more than I would think, right? And when I took a look at them. So actually, I think I could take us right here to kind of show you guys that. So right here, we have carrying amount, right? And these are all their assets, total assets. And you can see here, we have level 1, right? And this is all about loans, right? It's after all of the cash equivalents, that's actually above. And then level 2, we have level 2 right here. So we have about 275, and I think this is in millions. So 275 million. Yeah, it's in thousands. And then right here, we have a billion, right? A billion in level 3. And that goes for loans held for investment. Okay. And why is that level 3? But why is loans held for sale at level 2? Well, because level 3 has the ambiguity factor of whether or not you'll get paid back. Level 2, you're trying to sell those loans. You issue the loans and you're like, hey, you want to buy my loan? Here, I'll sell you the loan. This is the promised rate of return according to the loan terms, because it's a contract. You know, we get back to that contract and time stipulations and all that. And then here you go. I'll sell it off to you. I'll get it off my balance sheet, and I'll get cash in exchange for that, or maybe in exchange of another asset, right? And then level 3 is I'm going to hold it. I'm not going to sell it. I'm going to make that risk premium, right? That risk premium is going to be for me, not for anyone else. Okay. But what's the risk there? Well, what happens if they don't pay you back, right? Or what happens if they pay you some of it, but then they don't pay the full amount at the end, right? That is the risk here. So level 3, that's kind of what it's implying. The value is not certain, right? So that's the easiest way for us to kind of think about it, for the easiest way for me to explain it very quickly, is that level 1, we're more sure about. Level 2, we're less sure about. Level 3, we're the least sure about, okay? And then that's all you guys need to really know for that. I want to actually try to find the net income. So if not, I'll just go to the model, because sometimes I don't want to step. Oh, right here. Okay, found it. So we have revenue, right? This is the revenue breakdown. Okay, so we have merchant network revenue, virtual card network revenue, total network revenue. So they have a network, right? Because when you buy through a firm, you're buying through their network. It's an enclosed network. Okay, so you pay with your whatever, like you don't pay, sorry, it's the network itself. So you don't pay with the card, because if you use a firm, you know, you buy the product and then now you owe a firm the money, right? You owe a firm the money. So you'll get billed according to what the terms that a firm agrees upon with you, right? But again, that's the merchant network revenue. And I kind of explained more or less how that works between you and the merchant and a firm, and where a firm plays in. So we have interest income. Obviously, this is coming from the loans themselves, right? And then gain on sale of loans. Remember, we can sell these loans, right, after we get them. We don't have to hold them to maturity. And then they put that on their balance sheet as loans held for sale, loans held for maturity, right? Loans held for maturity, they're going to keep. They want to make that risk premium. And then servicing income, they might be still servicing those loans. Okay, so just because you sell the loan doesn't mean you don't have to also service them. And servicing is another feature. So I'm assuming that's what that means exactly. Okay, so and then total revenue is about $361 million. Okay, so I want to actually go back to see how big is this company. All right, we're at $11 billion. So right there, I'm already kind of like, dang, okay. Because they're trying to be kind of like a bank, but not a bank. It's a weird mixture of a bunch of things, I'd say. So we're seeing a revenue in 2021, but that's the 3 months, by the way. I want to be very clear. I think it's probably closer to a billion something in total. So I want to be very clear. And why were we looking at the quarterly results for the balance sheet items? Because the balance sheet items, it's very important to look at the most up to date. Okay, because it's a fixed point in time, but the income statement is over a period of time. So we want to look at the balance sheet at the most up-to-date document, and that was this one on their website. Okay, so that's why we're using it. But again, I think their revenues are close to $1 billion for 2021, somewhere around there. So yeah, and we'll look at their growth and all that stuff. But I think that's pretty much all I'll cover for these documents, because I just wanted to show you the class 1, class 2, class 3, specifically on their loan book, and then everything else, I don't know. I think this, yeah, this is a little bit important, but not crazy, not for me to spend too much time on. Okay, so let's actually then just move on to the model, right? So in the model, or before we actually move on to the model, I actually want to show one more thing. All right, so let me actually take us over here, because I think it's actually important that we look at the sales pitch of the business to kind of get an idea as for what the business is trying to say. Hey, look at us, we were doing all this. So right back there, that's the actual application that you can actually go on there and directly buy things. They have the relationship with the merchants. Taking a look over here, we have gross merchandise volume. You want to see this obviously growing. That's the amount of dollar terms in terms of merchandise going through their system. Active consumers going up. Transactions per active consumer. This is very important, because this actually implies that a lot of them are paying back in full and they're coming back. Because obviously I think that a firm would not let you come back and use their services if you don't pay them back and you leave them dirty like that. And then revenue obviously is accelerating. So that's actually a good thing for a growth company like this. All right. So this is ex Peloton. So they're trying to say, hey, look at us. We were very dependent on Peloton, but look at us. We're growing after Peloton. And then this is very important. So this is actually a firm itself directly. And then this is the point of sale. So a point of sale system. Remember, we go to the website, we buy it. We say, okay, I want to check out with the firm. And then they're like, yeah, here you go. Okay. So right here, this is also the breakdown of interest bearing loans and non-interest bearing loans. I would say that non-interest bearing loans is my preferred amount of loans, because those are considered to be less risky, because they're shorter duration. Shorter duration loans are less risky. You still have a risk premium because you are at the end of the day doing a loan. However, the interest bearing loans are going to be inherently more risky because they are extended into time, right? Credit card companies or banks in this instance, they don't really like to take on customers in that sense that carry a balance, and that's why you're punished with the high interest rate. If people like to think like, oh, the banks are, you know, they're blah blah blah, they're bad because high interest. It's like, no, you gotta understand, that's sort of like an incentive for you to pay out all your bills at once, right? So you pay your bills, you buy and you pay, right? You buy and you pay, because some people, they want to buy but they don't want to pay, or they want to pay little by little by little. And then the bank disincentivizes that, right, with the risk premium on that money that they have lent out to you. And then that's what's reflected in the high interest, right? Otherwise, they probably wouldn't be a value proposition for them, and it'd be very risky for them to lend that money out. A bank will still make tons of money if everyone just, you know, bought and paid, because they make money on the merchandise and all that. So they make money on the volumes, right? And that's preferable to me as an investor, to strictly have less risk in my system, and then just, you know, be that system in which you buy things and I just take a little bit off the top. Okay. And you can pause here and look at the breakdown, but you know, what's interesting, I'll just highlight this: fashion and beauty is 21%. I can only imagine that's like, you know, bags and stuff, you know. So active consumers, this is very important, right? But when we see hopefully merchandise is active merchants, this is very important, because at the end of the day, the relationships you have is with the merchants. Merchants allow you onto them. They have the power in this instance. Remember, we like to ask ourselves, who has the power in what relationship? Well, in this instance, merchants have the power, because they decide, hey, I'm going to put a firm on my platform, or I'm going to put Afterpay on my platform. And then again, I'll address the risks at the end of this video. So let's see here. Revenue is going up. Very interesting. Merchant fees. Okay, this is very self-explanatory. This is what I was talking about when they basically take the money from the merchant. The merchant value proposition is that they get customers they otherwise wouldn't have had, and their risk is not on them; it's on you. Blah blah blah. A firm. I'm mixing Afterpay and a firm in my brain. All right, transaction costs, all good, all good. I think that's where, oh, delinquency, this is very important. So delinquency, we want to make sure that this is maintaining steady levels. Forward year 2022, we see an uptick, and now we're seeing it hopefully come back down. 2021, we saw that uptick start, right? So 2020, we saw it they're going down a lot. And I guess that's because we had a lot of people switching to starting to pay with Affirm. So introduction of a bunch of consumers that, you know, we don't want to see this return to ordinary levels. If we do, that would be unfortunate for Affirm. I'd say that. But if we introduce a bunch of consumers that otherwise would not have been, of course, a lot of those consumers are going to be high value consumers. You know, this is still a very low delinquency rate, but, you know, it's higher for than some credit cards. I'll tell you that. The banks do release that data, and there are a lot of credit cards that have a lot lower than this. Okay, so, you know, it's not the best. All right, from here, let's actually, we're going to go on to the model and kind of see what's up. All right, here we're back to the model. Let's go AFRM. Oh, AFRM. Let's call forth the information. So on the low end of the growth, I'd say for now, the low end is probably like about 20%. And that is 20,000. So let's actually put the percent. Then after that, we'll say 25%. And then let's say here 30%. Then we go up to jump, a little bit of a jump to 40. And let's say on the high end, they achieve 50, not 50,000, 50, just 50%, please. Thank you. And then let's actually put in our discount rate of 10%. Let's lower this down to, I think the range that they could achieve longer term is 12 to 20%. And if I'm being honest, I think they can achieve it in 8 years for sure. So at an 8-year rate, these are the current assumptions, right? So we'd have to assume around 40% growth from here, which is, you know, feasible because they're growing right now in the 50s. That can slow down, but it is still aggressive. It's still quite aggressive. I'd say, you know, let's see what 35 gives us. 35%. So 35% still a good buy. 33%. And remember, I am discounting it at 10%. I'm assuming no dilution. It's very likely that they do dilution. But yeah, just saying. All right. So if we actually ask for a little bit of a margin of safety already there, we can't really assume that unless we do assume some higher rates right here. And maybe we call it forward a little bit by 4 years. So in that instance, right, we can assume a growth rate in the 30s, right? But that is still the assumptions being if they can achieve cash flow profitability within 4 years and have a steady amount of 15%, but it's probably going to be a little bit more lumpy. If we kind of average it out, it's probably going to be like 9% over that time period, because it will accelerate. It will grow from a low base to a higher base. So in that instance, we have a lot of risk priced in. But if you're looking for a lower rate of return over a long period of time, and it's not working with me, 8%, you know, we're pretty much there. And 8% is about 115%. And that might outperform the market over the next 10 years because simply where the market is right now, maybe not, you know, it just depends. All right. So that's pretty much with the valuation of Affirm. Affirm is, it's a better price than it was before. Above 100 was really insane. But, you know, in the 20s, it was actually fairly okay. And I think it was just there, but it just escaped us. And if I pull up Affirm's stock, let me see right here, the 1 year, I think they were just there. Yeah, 26. So they actually were just there, just didn't get the video out in time. But they're sitting at 40. So it's not the worst price, you know, up here was terrible, but I think we should focus mainly on the risk. And I don't want to be a Debbie Downer, but the risks here are that you are competing with competitors that have a lot of firepower. So for example, I mentioned very briefly, you have Block bought Afterpay, you have PayPal that's stepping into this space. So all of these competitors are coming in that have a lot more firepower than you. And of course, you know, you have the threat of the banks coming in, and the banks have a tremendous amount of firepower, especially primary dealers. You know, they are basically stable institutions of the government at this point. And for example, I know that in the POS system, so point of sale systems, Bank of America is coming in heavy, and they're trying to actually make a compelling case as to why you should just use them. And they actually stopped using Clover. They disconnected their consumer engagement with Clover, which actually is a big deal for something like Fiserv that owns Clover. So I actually didn't even mention that in the Fiserv video because that's fairly new information that they just did. I don't know if people are really talking about that who own Fiserv, because that's a big deal. So if Bank of America was your customer, now they're coming for your lunch money. and that they are a bank, they are a primary dealer, they have a lot of firepower, an incredible amount of firepower, you are basically going to bank on the fact that they have so much bureaucracy that they can't really execute, which is a very real possibility. They may struggle in execution, but they may not. Right? We don't know. We'll have to see. And I think, for example, a firm is an interesting acquisition target, like a tuck-in acquisition, because you have all these relationships for another company. If I had to guess, maybe PayPal. Maybe PayPal does a tuck-in acquisition. Maybe another bank does a tuck-in acquisition. Maybe, I don't know. It varies, right? There's a lot of ways we can think about where this could go. It's just speculation. I'm just throwing stuff into the wind. Or they may acquire something. Maybe they acquire something like an NCR and they get exposure to the POS, devices, and then they can develop greater relationships with their consumers, such as Target and Walmart, and kind of expand in that direction. Or, maybe they don't. Maybe, again, they're the ones who are acquired. But again, the risks are tremendous. It's not a business I entirely like. It's not a business that I think has a point of stability. You can make money by selling this to someone else at a higher price, obviously. And I want to also note, on the macro side, we are seeing a return of liquidity, right? So remember, we had the liquidity crunch. Now I think we are seeing an interesting return of money that was taken out on the sidelines, right? I mean, you can count myself as one of those. I was deploying capital, and I will continue to deploy capital in deals I find. But I'm kind of, right now, I'm a little bit upset, to be honest, because I wanted to keep buying more and more Facebook. I wanted to get to the gulp range, but it never really got there. So, but I was buying. And you guys who are watching my portfolio have been seeing the size of Facebook's portfolio as a percent of the portfolio increase. The portfolio is now doing really well. Again, and unfortunately, because I really wanted to deploy even more capital into something like Facebook or Meta and the other names that I have on accumulating, right? So unfortunately, I mean, I'm still buying because it's still within the range, but I'm not buying it as a good price as before. And something like AFRM is probably one of the ones that are going to benefit the most from this liquidity pump, not crunch. This liquidity pump that we're kind of seeing right now, we're seeing just the beginning of it, if this is really it. Who knows if this is it? I mean, we're already up 55% in AFRM. Not we, because I'm not owning AFRM. I want to be very clear. But the stock has shown a 55% increase from the lows, right? So that's a bunch of liquidity that's entering the market. And, you see what was off the Fed rate hike, and that kind of dispels those people that say, the Fed raising rates is bad for the market. It's nuance. It's really depending. And that's, again, if you haven't taken the Snyder pill. If you take the Snyder pill, you don't even believe the Fed has actual control, just psychological control. And if it is psychological, that's really interesting, because that's kind of what we're seeing. And that's what we're seeing on both ends. On the liquidity crunch, my thesis was simply psychological. And now, we are seeing it play out where the psychology is almost like, oh, they're going to stop inflation. And so now, we're a little bit more bullish. We also have China coming in and coddling, right? I made a video about that. The coddling has begun. I always talked about China is going to come in and coddle it. And now they're coming in and they're coddling, which is really interesting. And they did it the day after I made that video. So, but yeah, anyways, let's see what else did I want to cover. I think that's pretty much it that I wanted to cover as far as this goes. If you guys enjoyed this video, go ahead and feel free to leave a like. This is the conclusion of the subscriber request. I won't be buying this personally, but I do see why some people might be interested in this business. And if you guys aren't subscribed, go ahead and subscribe, and you can come back and probably see a video that of a stock that you're looking into personally, and I may be able to add a different perspective and hopefully aid you in your journey of deciding whether or not you like something, or maybe you didn't think about a certain perspective on that company. But on that note, guys, I'll see you guys in the next one. I do have a live stream today at around 6 p.m. and if you guys are free, I'd love to see you guys there. All right, have a good one, guys. Bye.